Okay, so today we will discuss about always in position. So one way of method. Okay, many traders are following this. So this method uh, consists of mainly finding good trades in the trend direction. So either trend will be upside or downside. So same always in position will be long side or short side. So if you are taking trade, so you have to uh, also give space to opposite party. So if you are in bull trend, so there are chances that sellers will get a minor two-legged pullback, and again it reverse and go above the first leg. So it considered as a bull trend. So in this scenario, always in position is to upside. So anywhere between you points, you can take trade and manage. If you manage well, you exit at good profit. Okay. So here are the some theory for it. So this is the pullback theory. You can go through it. Okay. So the which trend traders came in and heavily flight reversal attempt. So in what makes this position to the flipping? Okay. What makes always in position to flip in long or short side? This is the downside channel. Okay. So here always in position is to be downside. But after seeing this move, okay, so will you consider it to go upside trade? Okay, so here are the explanation for it. So reversal attempt, it considered as also reversal attempt. So this reversal will be flip this morning's move to the reverse. So here answer is no. There are sellers again faded it at EMA. It is H2. Okay, H1 somewhere here. So again, always in position will be short here. So who traded here or you even get in here, they will not exit or even they scaling and exit somewhere around here. So here are the points taken. So this is the 43-point rally. So here are 8-point rally, 5-point rally. So you can manage to get 79 point by considering always in position to the downside. Okay. So almost all traders required to spike in the direction of the trade before confidence. Okay. So it says that this bull bear bar, this bear bar, this bear bar. So these good looking bars are required to confess that always his position is on downside. Okay. If you see here, this is the spike. So better to assume that now this position is going downside. Okay. It is the sidebars day. Okay. Trading range day. So upper area where sellers are aggressive and below area where buyers are aggressive. You can take between trades. So if you see there is the 13-point downside trade, 9-point downside trade. This is the 7-point always is position is short. If you short trade here, not exited here, you again go short here, any good looking bear bar. Okay. So here are also same example, although they will use in reversal setup. So many traders are finding many swing trades based on this theory. Okay, so you can go through it. So here it shows the flag setup and then pullback continues to grow until, so it is the reversal which converted into counter trade. Okay, so if you see here, there are both counter trend players are also equally uh, taking opportunities. So if you consider it as a buying always in position, so in always in position buying side, you what you do, any flag pattern you will trade it. This is the small flag pattern. So you take trade here. So buying trade will be traded here. If you see this consecutive bear bar, so after looking bull bar at the bottom of this channel, so again buyers will come Okay, so it's easy idea. So my personal aim is to, okay, consider many day structures. So we are, by considering always in position, we can enter at anywhere in channel, okay, or in two-legged move, and we try to develop skill in managing this position and exit at good profit. Okay, if you see here, after seeing this bull spike, it is greater to assuming that this is the always in long side, means you can take trades on buy side. There is high probability of getting profit here. Rather counter trend, which are these players, okay, bear players are there, they are not able to get consecutive two bear bars, so they will ending up in losing. Okay, let's consider it as a, if we are buying this bull bar closing on high, so we are taking trades on close. So after seeing this bear bar, what you do, look, uh, your SL will be somewhere around here. Okay, if you are bought small parts here, half of the position here, so after seeing this bear bar, there is, it is the outside bar, so more chances are that it will be faded by buyers because it is the good opportunity for buyers. Okay, look at this move, it is the at least 60% downside move, and down 60% lower prices uh, are here, so buyer will take as an opportunity, buyers will buy here, and very next bar, which is the bull bar, at comes at a fair value. Okay, so this is the scenario. Again, after seeing this four consecutive bar, many buyers will buy above good looking bar. Okay, so here is the good looking bull bar. You just put SL2 here or below some tick to the EMA. So this is also good bull bar. Buy here, buy here, buy here. Okay. Now, after seeing this bear bar, okay, what we have to think? We have to think for if they got same bear bar like this in consecutive mode. So chances are that always in position to be flipped on their side. Okay. So after these five consecutive bars, what you can do is you can move your SL to here or partly book your profit somewhere high. Okay. If you notice here, there is first push here, second push and third push. So it's sort of wedge pattern created here. Okay. So here momentum is not very strong. So sellers will try to fade it. Sellers got three consecutive bars and break out to the EMA. Now buyers will try to enter here, but sellers are faded by two bar theory. Okay, so this candle, this bear bar, uh, convinced most of the sellers to go for sell position below here, because always in position is right side, downside. So more chances are that we get at least first and second leg to the downside. Okay, so bears will take entry here. If buyers bought somewhere here, they have to exit by considering it as a market will be going downside. Okay, so take one, two, three, four bear bar. This is the two bar reversal, buying closing on its side. So whoever traded on this bull candle by considering always in position is upside, they can now again enter here. Now these three consecutive bars able to reverse this down move to the upside. Okay, so their seller's leg, first leg somewhere here, and second leg which is traded here, these two consecutive bear bar, buyers have faded it and able to get breakout above EMA. Okay, so this is the best example I consider it. Okay, so there are plenty of examples are there, many day structures are there. Here also, this is the E-mini trade. This is one of electronic traded index is there. So I consider same looking pattern. So this is the 2017 or even rather older than that. Okay, I don't know exactly date because it is month month consider here. Okay, so same starting wedge pattern created here. Okay, so here is also same, and many traders will after seeing this half an hour range trade day, so they will put order above it and below it for buying and selling. So again same in Nifty same scenario happen. So these consecutive bars are able to make decision that always in position is for long side. So after any two-legged move or even bear bar, you can buy it, considering it market will go higher or market will stay in channel, which is the bull channel. Okay, so here 70 to 18 bar, which is the considered as a exhausted move. So first leg which is here, second leg which is here. If we consider wedge pattern, so this is the first push, this is the second push, and here third push are there. Okay, so here in up to 18 point, here sellers not able to get very good two-legged move. Here also two-legged move are there, but price not able to move even greater price action. Okay, price range is not there. So more chances are that after this move, uh, sellers will take entry and flip the position. So here this bear bar, okay, and this two bar reversal, same happened here. It is the same structure. So this converted most of the traders to go for always in position to downside. So here are the down move, and again EMA check, and after bear bar there is consecutive many bear bars are there. So here is the also best example are there. There is also another example is here gap up day. So from starting of the day, if you notice that there is no, okay, if you see, this is not good looking uh, bull channel. Okay, this is the bear bar which tried to go above, break out, and then pull back and close the good looking bear bar. So many traders considered as a opening reversal and always in position to be short side. So they will get further confirmation which they got here in this bear bar. So they confirm and they go for selling below it. So market traded below it for measured move. Here is the measured move. This move it considered as the exhausted move. Two bar reversal candle. Uh, Here the last bear bar, which is the equivalent to the bull bar. So these three consecutive bull bar converted many traders to go for long side, and whoever traded or participated in this micro channel of bear side, they will now take profit or exit at break even position. Okay, now by taking supporting to the EMA, these prices go on continue throughout the day. Okay, in bull channel. Now how we can trade it? If you traded well here and if you manage to exit in profit, that's good, but after looking this, there is no reason to go for short anywhere here because it's flipped the position to the always in long side after these three consecutive bar breakout to the EMA. If you see here that this bear bar tried to go below it, but it not got followed through. and very next bar, which is the bull bar. So after the seeing sidebars, this is not uh, looking here, but this is the bull bar which converted many traders to the go upside, and even fresh position will be created here. Okay, so if you traded also this top of the range, okay, so what you do, you just get in by half or one third of your position here. You wait to better entry at pullback. So this is the pullback where there is no consecutive bear bars are there. It means it is the pullback which will be triggered again at EMA. So again EMA, near EMA, they will get bull bar. So what you do, you just scale in here, okay, and after seeing this move, you take scalp out, or you move your SR to somewhere here. You again scale in here. So main concept is to go for scaling approach, okay, and stay in micro channel. My aim is to go for, if this is the bear bar, you if you traded fourth point, okay, bottom of the bear channel, then also you can make profit. Okay, so if you consider as a always in position is downside, so you take entry here, take again entry this bear bar, okay, you can again entry at bear bar. After this one, two, and third push, you can just exit here, anywhere, somewhere here. Okay. In this scenario, what you have to do is just, if you put first SL here, you can move SL to here. Below swing low, any swing low, you just move your SL. Okay. Here is also example that from starting of the day, bear micro channel are there. So many bear bars are there. Okay. This is the bear bars. Here is the uh, both chart I'll explain well. Okay, here is the upside movement where always is in position is to the upside. So if you are traded somewhere sixth point, okay, let's consider why I discussing here is because if you traded sixth position, let's say if you traded one half position here, considering it, I will get enough follow through for upside movement. But after seeing this sidebars, what you do, you just wait to end of the this seller's move. Okay, so after this you can take entry here. Even after this breakout, you again go for scaling, move your SL to here or below EMA. Okay, so that is the main idea to approach here. Okay, uh, if you also trade a 8 point days breakout level, so you go for one third or one fourth position here because your SL will be too large. Okay, and chances of scaling and sideways are more, so you go for one fourth your position. After seeing this price action, okay, it is the next day chart. Okay, so after good looking bull bar, you can enter here. If price stays above the EMA, you just move your SL to little bit trail it. Okay, so any bear bar will be faded by bars, so you can enter here. Okay, so it is the best way to explain always in position. Here is the always in position is converted into downside. Okay, so if you traded 21, you just look for 23, put your uh, stop order below it, you enter here, you can exit somewhere here. Okay, so if you trade also 24th point, you just enter below 25th bear bar and you can exit at 26. Consecutive two bear bar are there, so many traders will exit here because this is the 24 which is the first leg, 26 which is the second leg. Okay, so this is the small topic to discuss, always in position. You can go through it. I picked up this topic from Elbrook. Okay, so this is the book of here, Elbrook, price trading price action reversal. So I took topic from here. I want to also discuss many patterns. Okay. So here, if you say how to trade this H1, H2, how we can maximize profit here by always in position, because here main thing important is to participate at somewhere here. Okay, if you traded as well H1 point, so you can scale in here and exit very well here. Okay, so my aim is to them. Okay, so we will discuss in next video. We will go through many uh, chart like this and discuss it. Okay, thank you.